On today's episode, we are going to take a look at two software stocks that have seen quite a correction in the past few days. Both of these are cash flow machines right now. It's pretty impressive. And I do believe this is the first time I'm taking a look at both these companies in this channel. Like always, for each stock, we're going to take a look at future growth, fundamentals, technicals, valuation metrics, and just my overall thoughts. So let's get started. All right, so the first company we are going to take a look at is Koopa. This is a business spend management platform. They help companies with procurement, payment, supply chain, treasury, anything that usually has to do with some type of finance. Koopa works with them. If we take a look at their investors presentation, they show us a huge catalog of customers that they have right now. Right now, Koopa is traded under the Nasdaq as ticker COUP. It was down about 8% as I am recording this episode. And if we take a look from its 52-week high, the stock has seen crazy correction. It's down almost 40.7%. And it currently has a market cap of $15.8 billion. One of the reasons the stock price is down today is that Coupa did have earnings and they gave guidance for the remaining year, and unfortunately the guidance they guided was lower than what analysts expected. If we take a look at future growth, though, this company is expected to grow its revenues 23.3% on average for the next 3 to 5 years. Unfortunately, this company is not profitable at the moment, but it is positive in cash flow from operations, and that's one thing I'm really liking. If we take a look at this company's balance sheet, right now they have about $606 million in cash and about $1.5 billion in debt. They are a bit leveraged right now, but remember, we saw that huge positive in cash flow from operations, which allows them to kind of fund this type of expenses. If we take a look at the past 6 years, this company has grown its revenue by over 30% each year. In the most recent fiscal year of 2020, it grew 38.98%. And guys, before we go any further, make sure to hit the subscribe button, the thumbs up if I'm providing some type of value to you. And let's take a quick listen to today's sponsor, a big reason why I'm able to provide so much content a day right now. I want to thank the Motley for sponsoring this video. The Motley is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. Now that we took a look at historical revenue growth, I want to take a look at their operating cash flow margins. For 2020, they kept about 14.4%, and we can see throughout the years it has been improving. So overall fundamentals for Coupa are looking pretty impressive. If we take a look at their most recent earnings, which were today, the company reported 40% year-over-year growth. So some recent news about Coupa. A few days ago, on June 3rd of 2021, they announced Coupa Venture Funds. This fund will support the next generations of companies shaping the future of business spend management. So you can see Coupa is trying to stay ahead of the curve. They're trying to find small businesses right now that are working in the market they're working, and they're gonna invest in the ones that they find the most innovative. At the moment, they already added 2 companies into their portfolio, and I do believe this was a great move by management. Now the second company we're gonna take a look at is ServiceNow. This is actually a company recommended by one of my Discord members, If you're watching this video, thanks for suggesting this company. If you guys ever want me to take a look at any company, feel free to post on the comments below. So ServiceNow is pretty much a way to optimize your digital workflows. They have solutions, for example, for IT workflows. For example, if you work at a business, right, and you have an IT team with you and you need to order or repair or get a new laptop or some new hardware, the enterprise can use their solutions to make it easier for you, the employee, to get the product you need. In the employee workflows, this employee right here is asking, what are my options for where I work? And in response, the automated workflow kind of provides this employee with some of their policies of work from home or return to the workplace policy. ServiceNow can also be used to automate, for example, the returning to workplace. If you want employees to reserve offices or you want them to reserve kind of desk, employee workflows works perfectly for there. And if you want to learn a little bit more, I definitely recommend going to their website, especially their customer stories. They have a huge catalog of customers on their site upside right now. So ServiceNow is traded under the New York Stock Exchange as ticker now. As I am recording this episode, the stock is pretty much flat for the day, but if we take a look from its 52-week high, this stock has seen a nice correction as well. It's down about 22.5%. It currently has a market cap of about $91 billion. If we take a look at future growth, this company is also a nice growth, expected to grow 20.2% on average for the next 3 to 5 years. This one is profitable and they are positive in cash flow from operations. Super positive in cash flow from operations, if I may see. We're going to take a quick look at those margins. If we take a look at the balance sheet, this company has about $3.5 billion in cash and about $1.6 billion in debt. So they're not leveraged at all. This is a very strong balance sheet and they have very strong fundamentals. Now, if we take a look at historical revenue growth for this company, I'm looking as far as December of 2017. And since then, there has only been one quarter that has seen less than 30% year-over-year revenue growth, and that was 28.4%. You can see this is a monster, even though they are of big size right now. Like I mentioned, both these companies are money-making machines. If I'm taking a look at trailing 12 months operating cash flow margins, is 41.8% for the past trailing 12 months. This is a money-making machine. They have a strong balance sheet. I'm really liking this Q. If we take a look at most recent earnings, subscription revenues grew 30% compared to the same time last year. Subscription billings grew 29% compared to the same time last year. The renewal rate of customers is 97%. This is a very sticky business for sure. All right, so now let's take a quick look at technicals. I want to see if these companies are overextended. The first one we're going to take a look at is Coupa or COUP, and this right now I want to say is sitting at very attractive levels. Right, it is not overextended. Now, on the other hand, it's also looking pretty attractive. It's not as beat up as COUP, but it is nowhere near overextended. I do believe both of these are kind of sitting at a great place where they have eliminated a good portion of the risk. Obviously, they can continue to go down. All right, so now let's take a quick look at valuation metrics for both these companies. I'm going to take a look at EV to EBITDA forward, and both of them are sitting at levels last seen in about a year ago. And to me, that continues to reaffirm that a good portion of the risk has been eliminated right now. All right, so now my overall thoughts. I did enjoy both these companies, and if I may be honest, I wouldn't be mad if they were in my portfolio. At the moment, they're not. But if I had to choose one, I think it would be ServiceNow. If it was to ever enter my portfolio, that would be a tier 2 stock, but that one had strong historical growth. It has strong cash flow from operations. It even had a strong balance sheet. So that's definitely a company that's gonna be on my radar. Koopa, if it was to ever enter my portfolio, I think it would also be a tier 2 stock, but it would be a smaller position than ServiceNow. So I hope you guys enjoyed today's episode. Take care, have a good night, and see you next time.